what's pretty cool about this is that every time we think of abstraction in fintech or in money movement, it comes with a cost. It's kind of worse, right? Like it's simpler to use, but worse because you're taking assumptions from someone else that is abstracting that
It's
layer.
opinionated, yeah.
Exactly. But stablecoins are neutral and abstraction at the same time. And that is what makes them, in my opinion, very unique.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name's Simon Taylor. I'm your host for today, author at FinTech Brain Food and head of market dev over at Tempo. And well, today we're recording on a Thursday, or as it's better known in the United States, Thanksgiving. So you'll forgive us for letting Kai have this episode off, but we are joined by some genuinely incredible guests. Welcoming to the show is the Chief Product Officer of Wise, a friend of mine, Nilan Peiris. How are you doing, sir?
Very well. Excited to be here with you.
Yeah, likewise, man. I'm excited to dig into some of this week's stories with somebody who's in the weeds on all things cross-border and all things currencies. I'm also joined by, again, another heck of a payments expert, Luca Cosentino, who's head of crypto over at Cross River. How are you doing, Luca?
Fantastic, amazing morning here in the US.
Indeed. Well, I appreciate you bringing the Italian vibes to an American holiday. Thank you
Thank you so much
for doing that. Making that happen. All right, one quick bit before I get into the content. I've got to remind everybody that views and opinions of contributors today are their own and might not reflect those of companies they represent. Please don't take anything we say as tax, legal, financial advice, sports advice, fashion advice, clearly. Please always do your own research, folks. All right, and with that, let's jump into the first story. So this story was covered just about everywhere. Klarna, you may have heard of them, the big buy now, pay later company, has launched, or announced at least, KlarnaUSD, partnering with Bridge on the new Layer 1 blockchain Tempo. This is the payments first blockchain incubated by Stripe and Paradigm, and where I happen to work. They're using KlarnaUSD initially for their internal treasury operations, but potentially from there spreading out to other use cases in time when the mainnet launches. And potentially this means they would be generating more yield from their internal treasury operations. And they can move funds 24/7 without the need for banks in some cases. So Luca, you've probably seen a number of organizations now look to stablecoins for the corporate treasury use case, but you're also somebody with one foot in the traditional finance world. Why might somebody like Klarna benefit from stablecoins? What would your hypothesis for that be?
I think there are a couple of reasons here that I can think of. Number one, there is some genuine simplicity in moving stablecoins over dealing with traditional rails. Part of it has to do with multi-rail integration, and part of it has to do with maintaining the technology compliant with the standards of these rails, which is inevitably expensive for some of these companies. The second reason that I can think of is a progressive shift from fintechs, from service providers to platform orchestrators, to ecosystem orchestrators. And the stablecoin is one way to create an ecosystem around what you have built to that point. Maybe think about connecting the two sides of merchants and buyers, as well as streamline the backend operations. And so if that becomes the tool that is needed to interact with that ecosystem, then there is, again, an ecosystem advantage that can be created across the business that you've built at that point.
It's funny, you use the word streamlining and simplify. All of these things could potentially be done before, but streamlining and simplifying is still valuable. A lot of folks said that Klarna is just bandwagon jumping here. They jumped onto the AI bandwagon. They jumped onto the stablecoin bandwagon. But Nilan, is there a there with stablecoins here? And why might brands be attracted to them?
Well, firstly, congratulations on the win with Tempo. It's like a pretty awesome client to get Klarna over the line. So congrats, Simon. Just from what I understood from the announcement, this is for internal treasury movement of USD. That's the current scope today. Yeah. So this is a pretty, I think, sweet use case for a USD stablecoin. And just going down a level of detail here. In terms of dollar clearing between here, I guess it's internal Klarna accounts you're kind of restricted. So people hold USD around the world in USD accounts, but to move that money, they use Swift messages today. And those Swift messages eventually end up in the US with wire transfers happening between US banks. And it takes quite a long time to just move USD between your own accounts as a consequence. And you're also limited by, the limits of wire transfers in terms of their opening hours, etc., as you shared. So transitioning from that to a different dollar settlement network is pretty awesome. I do think USD stablecoins as a medium for dollar settlement is a pretty sweet use case. There's a couple of caveats that I should just go through, just as I've also tried to think through like uses of Wise or other companies. When we say USD stablecoins, we're talking USD treasuries, right? That are backed behind a coin.
Yeah.
And that's different to USD cash and pretty interchangeable. But when you get into corporate treasury within a bank or within a payments institution, there are obviously limits to your risk-weighted assets and what you need to hold a certain amount of USD in liquidity, etc., in your corporate treasury, etc. So, be interesting to understand how much of those assets that are currently on businesses like Klarna's balance sheet can be switched for USDC or whichever stablecoin variant they've gone with, and then what benefits they see from this, and then the rest that they can't, how would they work through that? If I've understood it correctly. So
they're launching their own stablecoin. It's not USDC, it's KlarnaUSD. So therein, one would suggest they're collecting more of the yield. So this is a little bit like holding treasuries, except you get to move them 24/7. When you just say it like that, it's like, which treasurer doesn't want that? Because actually moving those, the actual treasuries themselves, quite difficult, quite clunky, needs a brokerage, needs a treasury team. These stablecoin things sort of collect some of, not all of that yield, but they're programmable and they are 24/7. And so if you have multiple subsidiaries, each with multiple banks, sort of trying to move the money between all of those subsidiaries and all of those banks becomes an exercise in complexity. This simplifies and streamlines, to use Luca's words there. One of the things I speculated, Luca, and I'd love your opinion on this, is like doing instant merchant payouts as well, because as you well know, when somebody makes a payment online with a card or with BNPL, the merchant might not receive that funding instantly, or if they are, it's some sort of cash advance. Somebody's taking the risk in between. Are you seeing this sort of instant settlement use case start to pop up more and more?
Yeah, absolutely. Super interesting that you're mentioning this. I go back to simplification. This is both a case of simplification and enablement. If you think about the card flow, right? Like a consumer swipes the card, then there is some authorization process. Then the network, like Visa, MasterCard, have to say, yes, that went through, all good. And then they give the money to the bank, and then the money makes it available. The bank makes it available to the end merchant via the acquirers in between. So there is a little bit of a multi-step flow, and the money availability determines how quickly the money gets to the merchant. And if you do this on legacy infrastructure and you have a little bit of friction left and right, then all that friction sum up ends up being T+1, T+2, T+3 for merchants who then get the money later. Stablecoin give a primitive to move this money almost immediately. And so it's never going to be super immediate because there are some authorization benefits in that flow. And we can talk more if this is interesting. There is also some risks that are covered by the speed of the money there, which may be healthy for both sides of the equation. But let's assume that is covered and that's a benefit for everyone. Then the remaining portion is what part of the slowness today is not driven by the benefit, but it's actually driven by legacy. So we try to take that away. And it's a multi-party collaboration. It's not just stablecoin enabled that. Stablecoin makes it very easy because when you think of global companies trying to enable this feature across multiple geographies, the last thing that they want is having one different integration with different local rails, but instead they love one tool that works globally, and then they figure out in each geography what requirements need to be met. And so stablecoins are, one more time, another streamlining to very fast go-to-market that wasn't able
They're almost like an abstraction over
Exactly.
local payments rails. If you think of them as this abstraction above, I call them the rail above rails, like the abstraction layer. So I just integrate with that, and then somebody else can take care of the local integration so long as they connect into the stablecoin rail. So it's abstracted.
What's pretty cool about this is that every time we think of abstraction in fintech or in money movement, it comes with a cost. It's kind of worse, right? Like it's simpler to use, but worse because you're taking assumptions from someone else that is abstracting that
It's
layer.
opinionated, yeah.
Exactly. But stablecoins are neutral and abstraction at the same time. And that is what makes them, in my opinion, very unique.
So you said something else that I thought was interesting, which is the multi-party workflow. So with a smart contract or something like that, we can agree that, like 6 different legal entities, 6 different companies who are mutually, unknown to each other can have a single workflow through stablecoins if they all agree and sign off with PKI signatures to a smart contract. And this multi-entity workflow, this shared workflow thing, is where the programmability of stablecoins become interesting again, because it's this neutral layer. I could always write software historically. I could give you an API to my infrastructure, but orchestrating a flow of funds across multiple entities is a little bit harder. So that's fascinating, and I want to kind of just spike home the point you made here as well, which is there's a lot of friction. Sometimes a little bit of friction is a good thing. Like, what happens if the goods don't show up? What happens if it was a fraudster? Like, we don't want everything to be instant, but having the ability for it to be instant, if we did want it, would be quite nice. So, Nilan, I'm interested in your reflections, kind of on all of this. Do you think that somebody with 114 million consumer users would also be thinking, "Hey, cross-border, maybe we could start to do a remittances product"? I know that's something that's near and dear to your heart and to the folks at Wise. You've got a lot of experience there. Have you seen any upside from the cross-border use case?
Yeah, so I think when we look at stablecoin adoption predominantly for cross-border, there's 2 ways in which people talk about it. One is the stablecoin sandwich, it's a great word, which is when you're sending fiat to fiat, you kind of send it through stablecoin in the middle. And the second is more or less what you were talking through there for Klarna, where you instead of sending the fiat currency, you send a USD stablecoin to the end user. One where I see a bit more adoption is on the latter one. So my observation is that looking around the world in the markets that we're in, so we're moving about talking in pounds, 200 billion pounds a year, growing at around about $600 billion a year, I think that was right, and growing at about 20% year on year. And we're global, so we, UK, US, and Europe is only half, 25% LATAM, 25% APAC. The places we enable our customers to hold USD balances. We've got about 30 billion in balances globally. And the places we see USD adoption and people holding large USD balances are places where customers don't really trust their currency. So their currency is devaluing or very volatile. And in those areas, they'll hold the USD as a more stable store of value. The areas where we see customers beginning to hold stable coins like USDC or other variants is where customers don't trust their governments. And they don't trust their governments that put in place capital controls that will stop them from their bank from trading their USD back to local currency, because in those countries, like whether it's Brazil, whether it's Argentina, generally around Latin America and Africa, South America and Africa, we have volatile currencies, and there's a history of capital controls coming in periods of volatility. So one of the big advantages of stablecoins is that you can send USD, you can hold USD, and you can hold the USD in a wallet, and the wallets can be on your phone, and you can't shut it down, right? It's there. And we can work through like how governments.
But it looks a little bit like cash, right? Like physical cash in your hand would work similarly, but this is on your phone, and you can link a card to it, which can be spent online. So there's some nuance there.
Totally, and we should talk through. So I'm not kind of ducked the remittance question. We can go back to remittance, but just staying on this one here. So USD does flow from the US, for example, to Brazil, to Mexico, does get held in stablecoin wallets. And then on the utility on spending only really comes if it gets merchant adoption, or you get these clever stablecoin cards, and which enable you to use existing rails in order to do the payments around it. The bits I'd like to game theory through a little bit is like, say a government wakes up one day and suddenly its fiat currency is the USD. So everyone in the country is now holding, in Venezuela, 80% of deposits are now in USD. The government's lost the ability to print money anymore to get its way up its fiscal deficit. So I'm sure we'll see. I'm sure like a bunch of governments could see this stuff coming and trying to think through this accelerated dollarization. Like, what would they do about it? This is like one tail risk, and the other tail risk, and these are tails, are the day you give a stable coin and one USDC, say, as a stable coin, and you get back 99 cents. For whatever reason, something's happened, and it just needs one person to mess up their internal ledger or their risk, and you'll have a little bit of a flight away. But I think these are the types of crises that will happen, and the industry will get through and work its way through over the next few years. So I think there's a lot of opportunity for this. I think it is dollarization, and like I think governments recognize it's a dollarization. Dollarization has pros and cons. You talk, isn't it great if everyone used the same currency around the world? Yeah, it would, but then like kind of to work your way back.
There are consequences.
There are consequences to that, and like some people, like the national governments are built on like not relying on someone else's money. So this is where it could get interesting in the future.
It's not surprising to me that we're hearing a lot from the ECB about monetary sovereignty. Which is their way of saying we don't want to dollarize. Also questioning like how much is sort of hyperinflation a risk if you're in the euro area? Not really much of a risk. And also, Nilan, you'll of course be familiar with CLS and CLS currencies. This is the continuous link settlement bank that really does deliver massive efficiencies in the foreign exchange market for any of those currency pairs, making sort of stable coins look expensive if you are at the institutional end of banking. However, if you're outside the CLS bank for non-CLS pairs, then stablecoins start to look like a Swift plus CLS for everybody else. And I think it's those long tail markets, those long tail currencies, and especially exotic to exotic, where even the most ardent banker I speak to, cash management of 30 years at big GSIB will say, yeah, I see that use case, and so do my clients. And so I think that's starting to slowly turn. So we'll see whether that comes bottom up adoption. I know we've on a previous episode we had the CEO of MoneyGram, and from their remittance business, what they're now doing is they're monetizing the beneficiary. So historically they were a business that monetized the sender, but now they can monetize the recipient. The recipient gets a stablecoin wallet, you link a card to that. Once they've got a wallet and a card, you can start to offer them yield. You can potentially start to give them other financial products through the DeFi rails. So it's going to be fascinating to watch. I want to bring us to the next story, which I also saw in the block, but I first saw in a WhatsApp group posted by a guy named Luca. And this is Cross River Bank are launching a stablecoin payments platform that unifies stablecoin and fiat flows into a single interoperable system. The goal's to eliminate operational sprawl and the need to pre-fund or to rebuild ledgers in order to take advantage of stablecoins. So talk to me, Luca, about why you built this and what pre-funding used to look like before this platform existed.
The the best motivation is when you as a user have a little bit of a problem, right? And what I really don't love is I do have a MetaMask account, I have my Chase account, I have my fintech account, and all these kind of things I need to predetermine.
And the Wise account, of course.
And the Wise account, which I have. And so in each of these places, I do have to predetermine how much money I need to leave in each. And I never understand why it necessarily has to be the case. And when I looked at our customers building, cross-river customers building flow funds to start enabling stablecoin flows, really it's shocking how complicated the flow fund is when it could be really straightforward. So like the previous situation is you get an ACH that settles in a wallet. If you want the money available immediately, you need to pre-fund that. Then you need to park that liquidity as some stablecoin or market maker issuer and authorize the minting from there by using your own capital and balance sheet in between. So it's the second cost of funding that you need to sustain. On top of that, you have the fiat rails to maintain. Then you have the two ledgers, one for the fiat rails and one for stablecoin. And then you reconcile and make sure that payment one is reconciled against payment one on the stablecoin, and hope that the two talk to each other. Compliance flows are also broken, and so like sometimes they work, sometimes they don't work. All this to say that if something goes wrong in that kind of matching, effectively everything gets lost. But most importantly, the cost of building that product for these fintech companies is an order of magnitude bigger than what it could be in a situation that I thought should exist already, which is what we just launched, which is we have a core banking system, which we built. The core banking system opens accounts, right, for commercial or for the benefit of all these kind of things. Where the dollar settles, you can automatically convert it to stablecoin within the same infrastructure and send it out. There's no need to have different ledgers. There is no need to have different vendors. There is no need to have different pools of capital, but everything can be in the same place. That, in my opinion, is the missing element today, one of the missing elements today in the interconnection between fiat and stablecoins. And one of my goals in this effort was really to make the fiat and the stablecoins 100% interoperable.
Yeah, fascinating. I mean, Nilan, I know over your years you'll have had to build multiple ledgers, multiple flows of funds. Have you seen anybody that's been able to simplify those things? I know you guys are still on the journey of looking at stable coins, but more broadly, flows of funds, multiple ledgers, simplifying it sounds useful?
It does sound useful, and it sounds like incredible the work that you've done there, Luca. Just the complexities we have are much more around the interactions between like faster payment systems, real-time GS, real-time gross settlement networks, as well as our ledgers. So just taking a step through, so we about I think 75% of the payments on our network, so out of the 200 billion, settle instantly and was available to spend in the bank accounts at either end. So if you're sending money from, the way we do that is, and that instant we define as under 20 seconds. And when you look at the volume of that's going through that's pretty material. So the way we do that is when you're sending money from the UK to Singapore, we've got a couple of bits we spent a bunch of time building. We've got a bank account at the Bank of England, and we have a direct integration to FPS, faster payment system, which is the real-time gross settlement network in the UK. And we have the same setup in Singapore, and we have liquidity in Singapore as well for people sending money the other way. So when you're sending, say, £1,000 to Singapore, the money comes in by faster payments into our bank account at the Bank of England, and then we pay out in Singapore at the other end. So in terms of ledger and matching, you can kind of imagine what we need to do to, you've set up a transfer, we've checked, we've received the funds, we match it, and then we do the payout at the other end once that's been confirmed. And at the same time, run through all of the AML checks, sanctions checks, etc. The interesting bit for us is in some ways, we're centralizing into a single ledger that enables us to do these settlements and payouts outside. The fun bit is we've been building an enterprise product with Wise Platform, where we now have 200 banks on Wise. These range from Standard Chartered, Morgan Stanley, through to Monzo, N26, Ramp. And as these banks are on our platform and people move money between each other, then the money movement is just a database. change entry, and there is no money movement into fiat. This is very small at the moment, but this could get quite large over time. And we obviously share this in pricing back to our customers, which gives us a bit of a network effect as things begin to go and to accelerate. But we definitely see the challenges of where we interact, come back to your point on stablecoins, the opportunity with legacy systems. So, for example, if I was sending USD from UK to Singapore, then my setup is like incredibly slow and efficient. I send a Swift message to a bank, send a Swift message to a bank that ends up doing a wire transfer in the US, and that would be so much easier on Stables. So you can kind of imagine the areas that we would be exploring.
Interesting stuff, and also working really hard. I saw the US. I think it was Governor Waller talks about the skinny payments account, things of that nature. And because Wise was the pioneer of sort of getting direct access to central banks for non-banks. So interesting to see how those two worlds collide. How direct central bank access and all stable coins start to come together. Look at takeaways from this. Like, what are you looking towards over the next 3 to 6 months with this platform, and what are your ambitions with it? What are you hoping to unlock and enable for people? Give me some examples.
Yeah, the first need is, as I said, full interoperability. So the flows that we're enabling are everything that has to do with corporate treasury, on and off ramp, wallet funding, withdrawals, B2B payments, B2C payments, like all these kind of things are immediately unlocked by this feature. And the amount of demand that is being generated is pretty insane, and it's coming from every single angle. One of the probably craziest, but not that crazy, that we just heard is a company that is not in crypto at all, like probably doesn't even know what crypto is, to the extent that you have to know blockchains, etc., and said exactly what I said at the beginning, which is we need a way to send you money. We don't want to do ACH work because maintaining ACH is high compliance cost for us, where compliance means network compliance. And what if we just mint stablecoins from our account and we send it? Like would it be just easier to do it that way? And like, yeah, frankly, it makes it simple to do it that way, right? This is the level of thinking that is going on when I say simplification is important. Now, it turns out that if you build this infrastructure right, and you build it directly inside your core banking system with all the automated compliance checks embedded in it, with the full interoperability with the fiat rails and the ledger that we discussed before, then essentially you're very well set to serve a lot of the future use cases that have to do with tokenization. And here we entered all the card stack, right? Like from receiving money and paying money. Merchant settlement, which again, like receiving money and sending money to the merchants, entire flow could be done in stablecoin multiple days a week or more days a week than just 5. And then after that, it would be moving bigger assets than just stablecoins into the same infrastructure, because again, the ledger and the tokens can be interpreted finally from computers instead of being Excel spreadsheets that look the same, but the computer cannot really understand what's inside. That's pretty powerful. So we do believe that beyond the use cases that we can power today, we're really building an infrastructure that 20 years from now is still going to be there, and 5 years from now is going to be super obvious.
It's going to be very interesting to watch. All right, we're just going to take a quick pause here while we hear from our sponsors, and we will be right back. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Privy, a Stripe company. Stablecoins can't go mainstream without simple and secure wallets. That's where Privy comes in. Trusted by more than 100 million accounts, Privy lets users launch wallets instantly with familiar logins like email or social. It's consumer-grade user experience with enterprise-grade security. Start building with Privy. Learn more at privy.io. Tokenized is also sponsored by Fireblocks. Fireblocks is the stablecoin infrastructure of choice for global businesses from Visa to WorldPay to Bridge to Revolut. With over $100 billion in monthly stablecoin volume, Fireblocks powers stablecoin strategies at scale with infrastructure that enables PSPs, fintechs, remitters, and banks to issue, move, hold, and manage stablecoins. It's all done securely at scale with secure built-in compliance. With Fireblocks, you get complete control to build your own stablecoin orchestration layer, create payment accounts, manage liquidity, and access on and off ramps in over 60 currencies. It makes it easier for you to build and scale and expand your business globally. Learn more at fireblocks.com. Thank you to our sponsors. Next story I picked up at the block, and this is about Paxos acquiring Fortify, the MPC wallet. So this is their second acquisition of the year for more than $100 million. Fortify offers institutional-grade MPC wallet solutions that currently safeguards over $120 billion of monthly transaction volume. And of course, this follows Stripe acquiring Privy, which does something very similar, and Fireblocks acquiring Dynamic to become sort of somewhat full stack between license issuance, custody, and then this MPC wallet as a service seems to be the last piece. And of course, what I like about these wallet as a service things is you could potentially build something that looks like a neobank out of them, and the experience is getting a lot better. You tend to see they're quite thoughtful about how you could use credentials that you already have, like a Gmail account and others, to avoid, the long MetaMask 12-word password to log in or whatever it is, and the secret share code. But also, they become embeddable inside existing fintech apps, and that is really, really interesting. So, Luca, have you seen any of your client base start to look at using these things? Is anybody live with it today? What are your thoughts on MPC wallets and really that transformation in the customer experience?
Yeah, I mean, Paxos has historically been built for custody, if you think of the business model over the many years. So it makes sense for them to think of the wallet a bit less as a custody-only tool and a bit more as a ecosystem interactor tools, as you said before. So I think the acquisition makes sense and represents like a shift. We have always believed in MPC as a company, and also myself. It probably gives you the flexibility to be very protective on the custody side, but also very flexible on the experience side, however you want it. The protocol has been pretty resilient over the last few years. As far as I know, there have not been major issues. There have been some enhancements, actually. And I think over time has become little bit of the status quo, if I may, in wallet security. So I do believe that the direction is absolutely right. I do believe it gives you the flexibility that banks need. That there's a lot of ways that you can play with it to make it more secure or more flexible based on your needs. So yeah, I think the choice makes sense, and I think MPC is a technology that is here to stay.
Yeah, it's so interesting how there's a few full stack players emerging, like a Fireblocks, a Paxos, a Stripe family. This consolidation phase is really, really happening. Nilan, Chief Product Officer, you obviously think about customers a lot. What do you think the gaps are in customer experience for stablecoins, especially for sort of your consumers and mid-market SMB space? Is it still outside of the realm of what customers are asking for in your world, or do you think this is something where we just need to hide the wires and make it feel like dollars, and if it solves a problem, it solves a problem?
I think more the latter. I think if you look at the direction of travel in crypto, it's been in hiding away the complexity, and whilst simultaneously increasing the security and the distribution of the platform. And if you look at, I've seen, I'm sure you've seen some pretty slick apps coming out that are sending stablecoins and stablecoin variants around the world as ways of sending money and moving money. It's like a very slick customer experience with all of the MetaMask craziness obfuscated away. So I expect we'd see more like that happening. And I think there's an opportunity for that, especially in areas and markets where there's real demand for stablecoin remittance, as I talked through earlier.
One of the things that caught my attention as well was Aave has launched the Aave app, and there are a bunch of sort of stablecoin neobank apps for both SMBs and consumers, where on the surface it looks and feels like a dollar account, but sort of something that Coinbase was doing 6 months ago was allowing people to lend out their Bitcoin into vaults like Morpho and earn a return on that. Or they could borrow against their Bitcoin and spend without losing the capital, which is something that the ultra high net worth have always done. They don't sell their assets; they borrow against them and live off that, and then pay them off with the gains. This is now something that Aave is making available direct from protocol to MPC wallet, and it's kind of something that in 2021 everybody was talking about, but we actually saw centralized things like Celsius come along that were maybe not so good. Now we're sort of delivering on some of that vision, and it just feels like an app, which is quite nice. It feels like an app that solves a problem. So Luca, is fintech cooked here, or do you think that these things start to emerge? Does distribution still matter? Like, what's your take on all of this space?
First of all, distribution will matter a lot. Turns out that, in my view, what's really going to change is that the time to call it 100,000 users, I don't know if that's a landmark, but let's call it like a target, is going to be drastically going down, because if you can work globally day zero, clearly it's much easier to find 100,000 users globally than 100,000 users in one market. So clearly there is an aspect there. I would say this is part of one philosophical question that I keep asking myself, which is, are banks going to become protocol before protocols become banks? So I think it's kind of going back and forth into the spectrum. In reality, both words offer a lot of uniquenesses, and I keep going back to the definitive answer, which is the partnership of the two is where the most value will be unlocked. DeFi, in my opinion, or from what I'm seeing, offers a very interesting property, which some are criticizing, but I actually welcome, which is this idea that the maturity is no longer in there. Like the concept of lending against a pool instead of lending against a maturity, I think it's pretty interesting to explore. I don't know at what point this is gonna be not enough, but if you think about the traditional financial system trying to play with the maturity of the assets, how much you keep on a balance sheet, how much you don't keep on a balance sheet, like that kind of trade-offs, I'm wondering if DeFi offers like an alternative to the two traditional options. And so I'm very, very curious in that space.
Yeah, no, I'm with you. I sort of try and describe what Aave is doing as like private credit for retail. On one side, it's an investment asset class, and on the other side, it's a way to borrow at higher cost, frankly, but from a different kind of lender. And actually, a lot of private credit is fueled BNPL and some of the non-bank lending. And one could argue that's good thing, bad thing. Apollo and Blackstone would argue it's a very, very good thing. The banks would say this is not a level playing field. They're not regulated like us. The private credit funds would say, well, sure, but banks are levered 10 to 1. Versus, the private credit funds, which tend to be 100% backed, or, and have tranches for how that first loss capital works. So these are fundamentally different products. Private credit isn't an asset class that's generally sold to retail. And I think people get a bit of heartburn and a bit squeamish about whether we should or whether we shouldn't. But I would imagine there's a way to do this responsibly, and I would hope we would. You do see some companies that I consider further out on the risk curve, your Robinhoods, your Revolut, really pushing to deliver these sorts of capabilities. But what I thought was so interesting about Revolut's recent crypto announcement with stablecoins is they're honoring all stablecoins at par, redeeming for $1. And so by taking some of the risk in this space, they're getting that early adopter user base, and they're able to take those stablecoins and do treasury management with them in some of these protocols. And that can be quite lucrative if done right. So your treasury management function as a non-bank starts to look more like a private credit fund than it does a traditional maturity transformation type of bank. Wow, that was fun to nerd out that way with you, Luca. Thank you for getting into the real bank nerd stuff for that. All right, one last story. Speaking of banks, there's a story from The Block, and US Bank, the fifth largest bank in the United States, tests its stablecoin on Stellar. So this is not a tokenized deposit. They're issuing their own stablecoin. It's putting them among many other traditional financial institutions taking an interest in digital assets. But this is very interesting compared to JP Morgan, who has put their JP Morgan deposit token, JPMD, on the Base blockchain, only available to its institutional clients. And I think this is an interesting separation, right? Because a deposit is a liability of the bank. It could only ever be available to your own clients. Once it goes outside the bank, it's not a deposit anymore. So how do deposits go open loop? They probably need to turn into stablecoins. So these things are kind of not the same. But this stablecoin could be used as liquidity in DeFi. It could be transferable, and it's backed by deposits at US banks. So, Luca, what are your thoughts? I know you're looking at this as a banker. I don't know if this is something that's on your roadmap or not, or if you can share, but speculate for me why this might be interesting and why it might not, and what your thoughts are.
Well, I would say, starting from if is it on our roadmap or not, I would say this is what we launched. So it's more than a roadmap is in the past. I think I think the idea is that very excited to see banks playing with stablecoins. I think is absolutely the right way to think about it. Like it's no brainer to me. It should happen. Public blockchains should have more respect from the regulated industry than what they have today in general. Now, every time I read about testing, it's hard to make comments because you don't know what's behind that test, right? And so it's a little complicated to make like a judgment. Overall, I think it's a massive positive piece of news for the industry. I generally get a little bit more excited when I see that things are getting real. Testing, it's easy. Getting it real is not super easy.
Yeah, Banking Circle, SocGen both have live stablecoins that are out in market. So that's a different thing. Maybe in 12 months' time, we'll see something along those lines from some of the larger US banks. And to your point, there's a lot of tests. There's also the Swift Ledger, there's Project Agora, there's Partior. There are many initiatives to sort of start integrating and linking different central bank settlement systems like the ECB and the Indian central bank are working on connecting those things at the bottom. The banks are working at connectivity. All of this heavy infrastructure machinery takes time, but you could just launch a stablecoin and skip it. What struck me is why Stellar? Seems like a bit of a ghost chain at the moment, but they also the US bank folks said, well, it supports KYC natively, and it's very, very fast, and it's very, very cheap, so it does meet some of their needs. So could be interesting to see if Stellar makes a bit of a comeback. And really quite different to a lot of the banks out there who are really talking about tokenized deposits. Nilan, you're obviously familiar, I suspect, with JP Morgan's Connexus and token services. Is there utility in those internal blockchains and token projects to somebody like a Wise? Are they useful to you? Would something like this from a bank be more interesting to you?
I think it's very smart the way that you summarized it in terms of like if you're on there. Tokenized deposits are useful inside the loop, and you'll need to go to stable coins to get outside the loop. I concur with your thesis. I think that's a very smart way of looking at it. You can imagine that where we have central bank integrations, we use them, and if not, we work with banking partners, and we work with over 90 banks. You can imagine we work with the largest banks in the world, which would include companies like, for example, JP Morgan. So we're very familiar with their systems. It's interesting to think about from a technology strategy perspective, because JP Morgan's been probably the bank that impressed me the most over the last decade in terms of how it's grown its payments business. I think it's around 30 to 40%, don't quote me now, of the revenue line now, the P&L. Takis and the team really built something quite extraordinary there, and quite differentiated when you look at JP Morgan versus the other banks in having a huge payment stack. Underneath the surface, though, what they did was to buy a bunch of companies who are integrated into local payment system, banks and payment companies, and put them together. And when you're working with banks like this, you kind of can see this ugly underbelly fairly often when you're integrating with this bank. I'll start off, won't share names at this point. Integrating with this bank in one market and another market, and it's clearly an underlying different core banking system that you're integrating with, right? And it's very clearly a different API. But again, I think I can share this as public domain stuff. JP Morgan has worked on creating their own singular API that's now a bit of wraparound and done a lot of the heavy lifting on this. So it is very, very curious on their strategy. When you think about this, you think about tokenized deposits, and you also think about stablecoins and how these play together into a world where clearly they look at global payment volume. They think about how much of that are they going to take. I think it's the largest USD Swift clearer in the world, right? And then you think about the threat they've got there from stablecoins as completely killing that market. And then I think we're going to see their response, because like their share price and the DCF on their future profit is predicated on them continue to maintain hold of this payments market, specifically USD, and this growth in dollarization. So I think we're going to, in terms of banks that I expect to innovate in this space, I expect these guys to. And you're right that tokenized deposits are only ever going to be part of the answer. So I would expect to see something else. It's pure speculation for me, but that's
Yeah, no, we're allowed to speculate, and views and opinions are our own. That's the best thing about the disclaimer at the beginning of the show. But I think it's fascinating analysis to consider that somebody with the most to lose is also the fastest to innovate. That's a narrative that you don't hear very often. The Connexus product suite also involves the interbank information network, which is a very interesting bit of cryptography that enables you to, manage some of the KYC, AML, and sanctions screening that needs to be done with incredible privacy technology in a way that arguably Swift could have done but didn't. So they've been moving into innovation in a way that they often don't get credit for, because people view them as the big bank and they must be an incumbent. But actually, yes, they are, but that's forcing them to innovate. So credit where it's due. A couple of stories we didn't have time to cover this week. I saw that Tether pegged USDT 0 has now transferred over $50 billion. So that's kind of interesting that the Layer 0, the ultimate bridge between networks, its version of is pegged against Tether, and it's now starting to transfer more. So the idea of interoperability is coming. And also MoonPay has a bit license and a trust license, allowing them to custody for big New York banks. So possible pivot in the works for MoonPay. So look, that's all the stories we had time for this week. I want to thank everybody for watching and listening, but I also want to throw over to Luca. If people want to learn more about you and what you're building over at Cross River, where do people get hold of you, and where do they find out more about the product?
Classic answer. We have our website, but I'm super open to spending time with builders. At the end of the day, we build everything for builders. So if someone is curious, has ideas, is thinking of flow of funds, there's plenty of ways to find me: LinkedIn, WhatsApp, Snapchat, and I'm pretty everywhere. So gonna be easy to find my name.
You're Snapchatting flows of funds from whiteboards all day. That'd be fun.
Yeah, I'm not really on Snapchat. It was a joke.
So it's funny. I did my conference FinTech NerdCon last week, and the one big request was for a whiteboard zone, because there were so many people trying to map things out there. That's what happens when you put builders in a room. Things get built. Nilan, if people want to find out, yeah, man, we'll get you down next year. Cross River will be a major piece of it, I'm sure. Nilan, if people want to find out more about you and everything going on at Wise, where do they do that?
Yeah, hit me up on LinkedIn or X. These places you'll find me. Happy to take reach outs from builders, people looking at building products, especially people interested in working with me. We're hiring everywhere in the world, from the US to India to Singapore to London, as well as interesting fintech companies.
Ooh, interesting fintech companies. Go and reach out a day. All right, and you'll find me at SY Taylor on all of the socials. You'll find me screaming into the void at fintechbrainfood.com. And if you want to know more about Tempo, head to tempo.xyz. And for everybody that asked, email partners@tempo.xyz if you want to come have a look at what we're building. If you haven't already, you have to hit that like button, subscribe, and do all of the things that annoying podcast hosts ask you to do, like share it with everybody. Spam your friends. That is essentially what I'm asking you to do on this Thanksgiving recording day. Thank you so much for watching and listening. We will catch you next time.